So I join in the applause. I think we should thank Yuzuru and Nuno and everybody from the Arthur Lewis Lab for having organized a fine conference. I think I may be the one person in the room who actually met Arthur Lewis. He was on the faculty at Princeton when I was on the job market. He was there in the audience when I gave my job talk. I did not get an offer. If there's one slight criticism of the conference, from my point of view, it's that we've had a lot of presentation and not quite enough Q&A. So as keynote speaker, I'm being gifted with an hour. And my goal, this is called pre-commitment, is to speak for about 40 minutes and leave 20 minutes for Q&A at the end. International currencies in the lens of history. I think many people in the room can anticipate the context. And the context is all the chatter that we hear about the international role of the dollar and whether it's at risk at the moment, given recent events. The dollar is the currency of the United States, but also the dominant global currency. Other countries use it in their trade, not only with the United States, but amongst themselves, third countries. Trade goods that never touch US shores, yet those goods are invoiced and payment for them is settled in US dollars. A majority of global exports and imports are so invoiced and settled. The dollar is the dominant currency in international banking. The dollar is bought and is on one side of more than 80% of foreign exchange transactions worldwide. So if the US economy is 20 or 25% of global GDP, the dollar's footprint in foreign exchange markets is disproportionately larger than that, and more than half of the foreign exchange reserves of central banks and governments around the world are denominated in US dollars, either predominantly US Treasury securities, but also US dollar denominated and sometimes domiciled bank deposits. So the motivated question is whether this status quo will persist, a question on which I think history can help to shed light. Why the dollar is the incumbent global currency is no mystery. The dollar's dominance reflects the fact that the US is the single largest economy in the world, depending on how you measure things, as it has been since 1870. The market in US Treasury bonds is the single largest and most liquid financial market in the world. It has been freely open to foreign investors for the better part of, for a century and more. And here history casts a long shadow that for historical reasons, that only the US financial markets were open to the rest of the world in the aftermath of World War II, means that importers and exporters around the world really had no alternative to utilizing dollars for their cross-border transactions. Once everybody became acclimatized to using dollars, network effects became increasingly important. It didn't pay for any one agent to, or there were costs to moving to an alternative, and ubiquity translated into persistence. I would argue, this is not a view universally shared in the White House or the US Treasury at the moment, that the dollar's dominance confers significant advantages on the United States. It gives US banks and firms the convenience value of being able to do cross-border transactions in their own currency without having to buy currency hedges to insulate themselves from the costs of unexpected exchange rate changes. The US federal government is able to borrow at more favorable interest rates than otherwise because there is this additional demand for US Treasury securities out there. The US enjoys an automatic form of insurance because of the liquidity of the US Treasury market and the associated safe haven status of the dollar. So when a bad thing happens, investors around the world rush into US financial markets and into the dollar. Many of us, and I include myself, were kind of wrong-footed in 2008 when we did the bad thing in the United States. We allowed Lehman Brothers to fail chaotically, the dollar strengthened on the heels of that. So that we enjoy exchange rate insurance, and more generally, the US doesn't suffer capital flight or security market collapse when there is a spike in global volatility. And finally, because such a large share of foreign savings is held in the form of US dollars, and so many cross-border transactions go through the dollar and the US correspondent banking system, the country possesses a more powerful financial weapon than it would otherwise if US policymakers decide in their wisdom to impose financial sanctions on other countries. Those sanctions are more effective than they would be otherwise because of the dependence for all manner of transactions of agents around the world on that currency and on that country's banking system. So this is not an entirely happy situation for the other countries on the other side of this equation. And this unhappiness goes back a long way. It certainly goes back to 1971 when Richard Nixon's Treasury Secretary, the Texan and former Democrat John Connally, was berated by a group of 10 finance ministers at a meeting, I think in Paris, and he turned around and said, "What are you talking about? It's our currency, but it's your problem. You have no choice but to live with it." Discomfort with dollar dominance, in fact, goes back further than that. It goes back to Valéry Giscard d'Estaing, the French finance minister in the mid-1960s. It goes back to Jacques Rueff, the influential French economist and advisor to Charles de Gaulle in the 1950s. It goes back to John Maynard Keynes and his Bancor proposal in the 1940s, and I'm sure there are earlier. Ever since the dollar has been an important international currency, there has been discomfort around that importance. So people are looking around and contemplating alternatives. They're contemplating the possibility that another currency like the Chinese renminbi might develop into a meaningful alternative to the dollar, that the BRICS countries will succeed in encouraging local currency payments amongst themselves, that technologists will succeed in developing a digital platform or figure out how to run multiple central bank digital currencies on a single blockchain, providing an alternative to going through the dollar and going through the correspondent banking system. So as I write here, actual and hypothetical alternatives, those are all three hypothetical alternatives to the dollar. Actual and hypothetical alternatives are not the same. China's financial markets are not open to the rest of the world. Western governments and central banks, in addition, may be reluctant to rely on the currency of a geopolitical rival. And more generally, international investors, both official and private, might be reluctant to park a significant share of their portfolios in the financial center of a country that is a political autocracy, where the Politburo can change the rules of the game, change the rules of access to those reserves. So I had the pleasure of going to China a couple of times this year, and I've talked about this subject, and I tell my Chinese audience, every leading international currency of the modern period is the currency of a political democracy or republic, where there is rule of law, separation of powers, checks on arbitrary action by the executive, and my Chinese audience will listen to me respectfully. They don't respond to the point, but they listen. But now you can imagine the tables turn, where sauce for the goose becomes sauce for the United States as well, where there are increasingly questions about separation of powers, rule of law, and so forth. I'll come back to that. There have been efforts to encourage direct trading between other currencies. Russia and India engaged in 2+ years of negotiations where Russia would sell oil to India and India would pay with rupees, and Moscow quickly discovered they didn't want rupees. They couldn't do much with them, and vice versa. So these local currency settlement schemes haven't gone anywhere. In fact, the technological problem of running multiple central bank digital currencies on a single blockchain or on a single dedicated digital platform, that problem has been solved by the People's Bank of China. But there is a political problem associated with scaling up and managing such a system, and I'll come back to that. There's a much longer history of global currencies going back in time. So this is the shameless advertising part of the keynote lecture. This book comes out in March, and for me, it was a departure from what I've done before, in that it goes back not 2 centuries, but 2 millennia to the advent of coinage and currency. So the subtitle is From Croesus to Crypto. Croesus was the Lydian king responsible for the advent or the invention, depending how you think about it, of coinage. And we all know what crypto is. So that's the ambition of the book, to try to paint this as a coherent, cohesive story. So there have been, international is a somewhat anachronistic word to use before the world was a collection of nation states. But I'm thinking about the use of currencies for transactions across borders beyond the borders or the confines of the issuing political entity. You can think about the owls of ancient Athens as being used not only in Athenia, but in other Greek states and throughout the Eastern Mediterranean. You can think of the Roman coins of Julius Caesar and Alexander the Great and subsequent Roman emperors, which were used everywhere from modern Manchester, from the British Isles to the Levant, what we would now call Afghanistan, what we would now call portions of India. The Byzantine solidus was used throughout the Middle East and throughout the Mediterranean, mainly along the Islamic southern coast of the Mediterranean, but portions of modern day Iberia as well. The Florentine florin was important because it was used for cross-border transactions, not only in monetary form, but in credit form as well. So the famous Florentine banking houses set up first foreign mercantile branches and then foreign banking operations, where they could transfer payment between Florentine wool finishers and wool providers in the Low Countries or England by transferring bank credit denominated in florin, as opposed to having to actually execute the difficult and risky process of transporting actual coin and bullion by sea or across land. Didn't have to worry about pirates and didn't have to hire armed guards and all that. Spanish pieces of 8. We're going to talk later this afternoon about Chinese banknotes, but Chinese banknotes, by my understanding, were not widely used outside of China itself. So when China engaged in cross-border transactions, when it sold porcelains to the West, when it bought stuff from the West, much of that trade was settled with Spanish silver, which came in the form of bullion, but also came in the form of pieces of 8, the Spanish coins that were cut up into 8 pizza-sized shaped slices in order to execute smaller value transactions as well. So I think Spanish pieces of 8 were the first true global currency, in that they were used for transactions within and between the Western Hemisphere, China, much of Europe, and other parts of Asia and the Middle East. The pound sterling was the leading global currency, depending how you define things and think about them, from some point in the 18th century up until World War I, and arguably again in the 1930s, and that then brings us to the dollar era also in the 20th century. So so what patterns emerge from this history? International currency status, I think, rests on economic foundations, but also importantly on political foundations. So economically, it rests on the strength and extent of the issuing country's cross-border commercial and financial links. How much it imports, how much it exports, how much it lends to and borrows from the rest of the world. It depends on the depth and liquidity of that issuing entity's financial markets, and it depends on the presence of a guild, a private bank, a central bank to backstop that market, to effectively act as a lender and liquidity provider of last resort. So those are the basic economic preconditions: economic size and transactions, market liquidity, market stability, if you will. But there are also, somewhat less obviously perhaps, important political foundations of international currency status. So as I alluded to before, domestically, global currencies tend to be currencies that are used internationally or globally, tend to be those of states where there exists a separation of powers and rule of law, preventing opportunistic behavior by the issuer while ensuring that creditors have voice. So one can think of some limited counterexamples where a benign dictator or king prioritizes or values the stability of the currency, does not act opportunistically for an extended period, where this association between separation of powers, rule of law, et cetera, on the one hand, and international currency status on the other is not absolute, but I think it is a strong correlation with strong political intuition lying behind it. Internationally, international currency status depends on the issuer's ability to forge and maintain geopolitical alliances. So central banks, governments prefer to hold and use in transactions the currencies of their trusted alliance partners. They trust those alliance partners to be good stewards of their reserve holdings. To hold and use the currency of an alliance partner is a show of goodwill toward that partner who will be called on perhaps to provide security services sometimes in the past. So you can kind of anticipate where I'm going to be going in terms of the prospects, troubled prospects for the dollar, given this perspective. So an example of this from 2 millennia ago would be Athens and its owls. So Athens was a large economy by the standards of the time. It engaged in extensive commercial transactions, trade in commodities, also in slaves throughout the Eastern Mediterranean. Its Port Piraeus was the leading trading center of its day. Imports of wheat into Athens were higher on a per capita basis than imports into the Netherlands in the mid-17th century, the point where the Dutch guilder was the leading international currency. So big trader, state with considerable administrative capacity, territory administered by Alexander stretched from mainland Greece to Anatolia, Persia, Afghanistan, even portions of India. The coin was of high quality, and its weight and fineness, in other words, percentage of precious metal content, remained basically unchanged for several centuries. And Athens had the ability to project military power and influence beyond its own borders. It was a powerful seafaring power. It was the head of the Delian League of Greek states, important political and military alliance. Or consider Britain and sterling, reeling forward 2 millennia in the 19th century, Britain was the first industrial nation, the leading exporter of the 19th century. Britannia ruled the waves. A quarter of the world was painted red in the maps that the British government published and promoted. Sterling was on the gold standard basically at an unchanged parity from 1717 to 1914, with a relatively brief interruption during the French and Napoleonic Wars. No other country could say the same. The gold standard was synonymous with stability in historical reality and in the minds of contemporaries. London was the leading international financial center of the day. It had far and away the deepest and most liquid financial markets from the 1820s onward. It had a market populated by a diverse collection of security brokers, dealers, acceptance houses who would attest to the quality of those securities, and banks. It attracted large numbers of foreign banks to do business there. So by many historians count, half of global trade and more than half of global cross-border financial transactions toward the end of the 19th century were financed in London and denominated in pound sterling. And of course, it had the Bank of England to backstop the market. So financial historians love to debate when the Bank of England exactly acknowledged and began to act on its lender of last resort responsibility. Was it the financial crisis of 1825? Was it the Over-and Gurney crisis in 1866? Was it only the Bering crisis in 1890? I would go for either 1825 or 1866 myself. So with that historical perspective, I will return again to the motivating question of whether the economic and political prerequisites for continued dollar dominance pointed to by this history remain in place. There has been, in fact, some relatively gradual, almost glacial decline in the global dominance of the dollar over the last couple of decades or quarter of the century. So you look at the dollar share of known, identified, allocated, three words for the same thing, foreign exchange reserves of central banks and governments around the world. That share has declined over the last quarter century from a bit more than 70% of the world total to a bit less than 60% of the world total now. So the dollar's market share has fallen by about 1/2 percentage point each year on average over that period. Gradual, maybe glacial. Whenever I say glacial now, I'm reminded how glaciers melt very gradually until they collapse and fall into the ocean. Same is true for currency pegs. If you count the number of countries that peg their currencies to the dollar, that number has been declining very gradually or glacially as well. Some other measures, invoicing of trade in dollars, there hasn't been any visible movement there. But we know that these different functions of a global currency go together. They complement one another. If you're making payments in dollars, it pays for your central bank to hold reserves in dollars so it can make dollars available to firms making payments. If your banks are doing transactions in dollars, it similarly pays for corporates to borrow in dollars and central banks to lend in dollars. So these complementarities mean that the different dimensions of global currency dominance tend to move together over time. So my expectation would be we will see some gradual movement along these other margins as well over time. Why have we seen this movement, and why could the glacier, which has been melting very slowly, begin to disintegrate much more quickly? So to be clear, I'm not making a forecast here, but I think it's important to contemplate the possibility that this movement could accelerate, and then to ask the question, how should we expect central banks and governments and others to prepare for the eventuality or the possibility? So why might it accelerate? because of tariff follies, because we know that if a country is an important trader, its currency is more likely to be attractive for international use. And there are questions raised by Liberation Day and other events about America's ongoing commitment to trade. There are fiscal follies, fiscal problems in the United States as well, worries about the, if nothing is done, the explosive growth of the US debt to GDP ratio, currently at 100% debt in the hands of the public, not in the hands of the Social Security Administration, et cetera, is 100%, and unchanged law that goes up to 150% over the course of the next couple of decades. There is deep-seated opposition to expansive government in the United States. That translates into deep-seated opposition to higher taxes. That translates into inability to do much of anything about this fiscal problem, giving rise to fears that the US will be unable to get its arms around the problem, forcing the Fed to inflate away the debt, fiscal dominance, money financing, et cetera. Financial follies, financial instability if deregulation goes too far. So portions of the Dodd-Frank Act were rolled back in recent years. The adequacy and efficiency of regulator oversight of the banking system, we should always be asking questions about that. History tells us to. Silicon Valley Bank was an example of banking train wreck that the Federal Reserve Bank of San Francisco Regulatory Department did not see coming. And now we have the Genius Act, which is the Stablecoin Act that authorizes Walmart, Amazon, and whoever else wants to issue a stablecoin to back it fully by holding US Treasuries or holding bank deposits at the likes of Silicon Valley Bank. So there was one of the consequences of Silicon Valley Bank's failure in 2023 is the second most important stablecoin circles went to a deep discount because people began to wonder what's going to happen to their deposits at SVB. So there are financial things to worry about. There are other things like private credit that I don't understand that people say we should be worrying about as well. There are worries about steps that have been taken in the attempt to compromise the independence of the Federal Reserve. Most recently, President Trump and Bill Pulte's attempt to fire Lisa Cook, one of the Federal Reserve governors. That case will be heard by the Supreme Court in January, but it potentially sets a very troubling precedent in terms of the ability of the executive to exercise leverage over the central bank, where Trump has already said he wants the Fed to cut interest rates by 350 basis points. So that could have inflationary consequences, and I think international investors will be watching. There are questions about whether such a new Federal Reserve Board in its wisdom will continue to act as an international lender and liquidity provider of last resort. So the central banks are around the world are more comfortable about allowing their local banks and firms to use dollars if they themselves have dollars that they can provide those local banks and firms in extremis. And the Fed helps to make that possible by providing dollar swap lines to those foreign central banks. When it did that in 2008, 2009, certain members of Congress objected that the Fed was giving away the hard-earned tax dollars of US taxpayers to foreign central banks. That was a misunderstanding, but if the Congress can misunderstand, how can we rule out the possibility that a newly installed Federal Reserve Board comprised of who knows whom could misunderstand as well? There are then some really out there proposals, including this one from President Trump's Council of Economic Advisors chair on leave, currently on the Federal Reserve Board, to tax the treasury bill and bond holdings of the central banks of foreign governments of foreign countries that we don't like. Treasury Secretary Bessent has the idea that we can deal with the debt problem by forcibly converting outstanding treasury bonds, maybe bills too, into century bonds, 100-year securities, bearing, say, a 2% interest rate. If foreign central banks, foreign commercial banks, foreign corporate treasurers see this kind of thing coming, they will presumably want to get out in advance. And the US has been taking increasing recourse to financial sanctions over the years. Here I show you their number. These are sanctions on individuals, corporations, governments, and you can see their frequency has been rising over time, and it's widely argued that weaponization of the dollar against Russia in 2022 and more generally could hasten this search for alternatives as protection against the dollar weapon. Most importantly, to my mind, is weakening US alliances, questions about US commitment to NATO, questions about its commitment to other alliance partners. And again, you can see the connection between alliance politics and currency dominance in history. The Dutch guilder came to be utilized in Asia only once the Dutch East India Company was established to engage in trade, but also to engage in security or military operations to subjugate local populations and seize, control strategic ports. Sterling was the invoicing and settlement currency of the world when Britannia ruled the waves. The German and Japanese governments supported the dollar in the 1960s. Whenever the dollar weakened, they would buy dollars and provide the US with gold as needed because they relied on the United States for their security, for their nuclear umbrella. Today, the Bank of Japan and the Bank of Korea hold a larger share of their reserves in dollars than their trading links and financial links with the United States and the average behavior of other countries would lead you to expect, because they continue to rely on the United States for their security umbrella. So this is part of an implicit bargain, if you will, security in return for, in part, in return for in greater use of your currency. So there are multiple reasons to contemplate the possibility that at some point in our lifetimes, the dollar could grow less dominant globally, and that it might grow significantly less dominant. So that raises the question, what, if any, alternative will governments, central banks, corporations, individuals turn to, if not dollars? Here are my 5 candidates: gold, the euro, the Chinese renminbi, other currencies that have not traditionally played an important role in the global economy, and a network of interoperable central bank digital currencies. So to anticipate, my view is that all of these alternatives have significant limitations. One can imagine that they will gain a global role more quickly as a result of mounting doubts about the stability of and access to the dollar. But even collectively, they can't fill the dollar's shoes were the United States to vacate them. So gold, as you will know from your newspaper reading, is back. Here are, at constant prices, million fine troy ounces gold holdings of central banks. And you can see that that had been declining for half a century or so, up to the global financial crisis, which seems to be a turning point. That advanced country, I'll show you that advanced country central banks had been trimming their gold holdings, having accumulated disproportionately large shares of gold from prior history. And meanwhile, emerging markets had been accumulating small amounts of gold. Those small accumulations became much larger accumulations sometime after 2010. So here you can see again in volume terms that those purchases have been almost entirely uninterrupted since 2008, reversing that long-term trend. So this one is market valuation. The higher price of gold in recent years is part of what's pushing up the right-hand tail of that figure. And here is the distinction between advanced economies, which had been trimming their gold holdings. They had an agreement amongst themselves about how quickly to do that. That basically expired also. None of them wanted to destabilize the gold price by selling too much too quickly, so they had a little cartel agreement to limit their sales. But you can see those sales here, and you can at the same time see the emerging market purchases begin to pick up. And we saw earlier how the latter has come. You can see here in the line how the latter has come to dominate. The attraction of gold is historic. On the one hand, this is something that central banks are supposed to do. And there is kind of a subconscious or maybe even conscious association in the minds of many observers between gold and financial and other security. The other attraction of gold, of course, is that it's free from being frozen, garnished, repurposed in the event of sanctions, so long as you put it on a boat or an airplane, bring it back home, and vault it at home. So that's what Russia did in 2013, 2014, right before it annexed Crimea. It began to fear that it would be subject to financial sanctions, so it brought all of its gold previously held at the London Metal Exchange, Bank of England, New York Fed, back to St. Petersburg and Moscow. I have a paper here asking whether gold is no longer a barbarous relic. We look at historic sanctions and find that there is an association between the imposition of sanctions on a country and its central bank's subsequent decision to increase the share of its foreign reserves that are held in the form of gold, an effect that is statistically significant. I write here economically important. The share of the total foreign portfolio in the form of gold is an additional 4 percentage points if a country has been subject to sanctions in preceding years. And I mentioned to you how the Bank of Russia acted preemptively. The share of gold in its reserves in 2013 had been 9%. It upped that to 21% by this portion here by 2022. Repatriation of gold enhances financial security, if you will, but gold is clunky and difficult to use in international transactions. So there's a famous story about how Venezuela used gold to pay Iran for oil field equipment and services. And they had to hire a couple of Russian 747s or whatever Aeroflot's equivalent of 747s is in order to ferry the gold to Tehran. You can use gold financially. You can lend it at interest. You can use it as collateral for financial transactions if it's vaulted in London or New York, not if it's vaulted in Moscow or St. Petersburg. So we may be seeing an end run around that as a gold repository is established in Shanghai, something that, Russia can move its gold to Shanghai, at which point it may be usable for financial transactions as well. But you get the point that gold reserves are relatively safe and relatively illiquid. The euro was created in part. The fathers and mothers of the euro, one of their motivations was to create an alternative to the dollar. That's what the Werner report in 1970 and the Delors report in, when was it, the late 1980s were fundamentally, in part at least, about. But the euro has gained essentially no ground as an international currency since its creation. So its predecessor or legacy currencies, the French franc, the Deutschmark, had played something of an international role, especially in Europe's own neighborhood, and that carries over. Subsequently, this is from the European Central Bank. It's a composite index of all the different things that currencies are used for internationally that I described to you before. Payments, invoicing on the foreign exchange market, and so forth. And to quote my former boss at the IMF, Michael Musa, this looks like the electrocardiogram of a dead person. The Chinese renminbi, people talk about it a lot, and its international footprint is growing fairly rapidly, but from a very low level. So its share of global foreign exchange reserves is on the order of 2% compared to the dollar's 58%. Its share in global foreign exchange transactions is less than a tenth that of the dollar. The New York clearinghouse clears by value 30 times the transactions in dollars that are cleared by China's equivalent, its cross-border interbank payments system. So this is the role of the Chinese renminbi in reserves, the little red sliver there. That disparity is clearly rooted in history. So the United States has been hard at work at internationalizing the dollar since 1913. Several of the founders of the Fed, led by Paul Warburg, wanted the Federal Reserve Act because they wanted to permit US national banks to branch abroad, something that they had not been permitted to do previously, and they wanted a central bank to provide liquidity into the market for trade credits, all of which is to say that institutional changes designed to promote cross-border use of the dollar have been underway for more than a century. China has been engaged in this process for, depending on what you count, 15 years or so. So even if cross-border use of the renminbi continues to grow at double-digit rates, something that I wouldn't expect to happen now that China's GDP is growing by 4%. Even with the miracle of compound interest, it will take decades before the renminbi comes within hailing distance of the dollar. So this is global foreign exchange reserves according to the IMF, and the little brownish red sliver there is the Chinese renminbi. Renminbi internationalization by many measures has actually stalled out. China has stopped making progress in recent years. Growth has slowed. Financial problems in China have deepened, housing market crisis and all that. Political rivalry between China and the West has grown more intense. So there are many potential explanations for this leveling off, this stalling out, if you will, and you see it also in a variety of other markets, cross-border bank clearing and so forth. So China, this is China's own trade settlements. China settles half of its own exports and imports in its own currency, where previously it had relied heavily on the dollar, but third countries hardly use the renminbi in transactions that are not with China itself. And if you try to reconstruct from data reported to the IMF or central bank annual reports who holds reserves in Chinese renminbi, the answer is Russia, which is this big slice of the pie. If you go down this list, there are some other somewhat surprising holders of reserves in Shanghai, but the amounts are relatively small. And it's not surprising that Russia holds a significant fraction of its reserves in renminbi. That harks back to the alliance politics that I talked about before, that China is either Russia's ally in its conflict with the West, or China is studiously neutral in that conflict. I pointed an arrow here to a historical article. I don't know how many economic historians read economic policy, but we have a paper there looking at global currencies that looks back at the pre-World War I period, when gold was important for central bank reserves, but currencies were important for cross-border payments. And central banks therefore held currencies as well as gold. The pound sterling, the French franc, the German mark were all consequential international currencies for payments and for central banks before 1914. And again, central banks and governments held and used the currencies of their alliance partners. If you look at the Triple Alliance and the Triple Entente and you compare, ask what currencies did their central banks respectively hold, the answer is those of their alliance partners. Non-traditional reserve currencies. So I told you before the dollar had lost market share. It's in reserves down from more than 70% of the global total to less than 60% of the global total. Of its losses, the renminbi accounts for about a quarter of the offsetting gains. 3/4 of the offsetting gains are other non-traditional reserve currencies. The Australian dollar, the Canadian dollar, the Singapore dollar, the New Zealand dollar. I don't know why they're all named dollar and they fit here. If they're not called dollar, they're called krona or something very close. The Swedish krona, the Norwegian krona, the Danish krona, and then there are a few ringers like the South Korean won mixed in. And these are held by a variety, these non-traditional reserve currencies are held increasingly by a wide variety of countries around the world. This has happened because of the advent of electronic currency trading platforms. You can trade currencies on your phone, and banks and others can trade currencies, including these, at historically narrow bid-ask spreads because of algorithmic liquidity providers into the foreign exchange market and ease of access through these electronic platforms. Finally, what about a network of interoperable central bank digital currencies? So this is central bank money in token form, if you will, stable coins, but issued by the central bank and not by Walmart or Amazon. And one can imagine, central bank digital currencies at the moment are mainly used within the issuing country. So you can use China's CBDC only if you are resident in China. One can imagine that they could be used in cross-border payments, that a bunch of them could run on a single blockchain or be traded on a single dedicated digital platform. And we have such a platform. It's called Project mBridge, involving the PBOC, the Bank of Thailand, the Hong Kong Monetary Authority, the UAE, and now Saudi Arabia, which may be interested in accepting payments for its oil exports to China in ECNY and using that ECNY to finish constructing the line, who knows. So the code for mBridge was written in the Digital Institute of the PBOC. The validation protocol, it's called the Dashing Protocol, was written in the Digital Institute of the PBOC. This is a PBOC-led project. It works. Actual transactions at a low level are being conducted on it every day. But the issue, it seems to me, is scaling it up not only economically, but politically. The political obstacle is that the participating central banks will have to agree on who regulates the operation of the platform. They will have to agree on who to admit, if anyone, as additional members. They agree, the 5 of them now, by consensus. When they're 25 or 45, there'll have to be voting rules. Will it be one country, one vote? The dominance of China kind of suggests not. All of those questions remain open. So I have my doubts about whether this will ever evolve into more than a regional system dominated by China, where it may play more of a role. Finally, I was asked earlier whether there would be a slide on the interwar period. Here's my last slide on the interwar period. Finally, central banks and others may choose to hold fewer reserves. The result may be less global liquidity, more expensive access to the kind of liquid assets that can be used for cross-border transactions. Fewer reserves will mean less capacity to intervene in markets, greater exchange rate volatility, global liquidity shortage like that we saw in the 1930s, where global trade and finance collapsed because of tariffs, because of debt defaults, but also because of volatile exchange rate movements and banking and financial crises that led to a shortage of global liquidity. The shortage of global liquidity also being evident in the deflation of the period. So this is not the famous Kindleberger diagram. This is the League of Nations diagram, which is where Kindleberger took it from, but you can see the spider web-like collapse of global trade that accompanied these events. So I worry that the end game, were the dollar to meet its maker, would be serious problems for the end of 21st century globalization as we know it. So we have to hope that that scenario does not develop. So I failed in my effort to go only for 40 minutes, but I left some time.